Hello and welcome to our commodities podcast. I'm Ravindra Rao from Kotak Securities Commodity Research Desk. Today we'll talk about what's happening in the world of commodities and what to watch for in the coming week. In a much anticipated address at the Jackson Hole Symposium, Federal Reserve Chair Jerome Powell acknowledged the progress made in mitigating inflation from its peak last year. However, he emphasized that inflation remained too high, suggesting that interest rates could remain elevated for an extended period, leaving room for additional rate hikes. Powell also emphasized that policy would remain restrictive until inflation consistently declined towards its 2% target. The Fed had raised its benchmark interest rate to a range of 5.25% to 5.5% in the previous month, making the highest level in 22 years. As expected, Powell highlighted economic growth and labor market conditions would be closely monitored when making policy decisions. Earlier in the week, the resilient US economy contributed to the belief that Federal Reserve might maintain higher borrowing costs. This pushed US 10-year Treasury yields to a high of 4.36%, levels last seen in November 2007. However, yields retreated following softer than expected PMI data, prompting a resurgence in gold prices, which saw a weekly gain for the first time in 4 weeks. COMEX gold rebounded sharply from its lowest point since early June, rising above 1950 per troy ounce, despite the US dollar breaching 104.3 levels. COMEX Silver also closed the week with a notable gain of 6.51%, boosted by rises in both gold and industrial metals. Although investment demand in bullion remained subdued, nevertheless, strong central bank purchases have consistently supported global gold demand in recent quarters, a reflection of heightened geopolitical tension and macroeconomic uncertainties. In terms of price action, US dollar index has comfortably breached the 103.60 resistance and is currently trading close to 104, 104.09. The next resistance in dollar index is near 104.70, which is the high tested in the month of at the end of May 2023. So that would be a good resistance, and on the lower side, the support is close to 103.60, which was the earlier resistance, followed by 200-day moving average support of 103.12. So we expect the dollar index to stay in this range. On the higher side, we feel 104.70 would be the cap, and 103.60 followed by 103.10 would be the ideal floor. So any triggers favoring dollar index would take prices further higher towards 105.80, but provided it breaches 104.7 on the higher side. In case of COMEX gold is currently facing resistance near $1953 per troy ounce mark, which coincides with the 60-day moving average resistance. To gain control and drive prices higher, the bulls must successfully breach this 60-day moving average resistance on a daily closing. Failure to do so may result in price consolidation within the $1950 to 1915, that is 1.5 per troy ounce range. In case of silver, prices have continuously moved higher and is approaching the resistance near 24.53 dollar per troy ounce. If that is taken out, we might see further highs in silver towards 24.80, which should be an ideal resistance, which is the trend line resistance on the higher side. If that is broken, we might see fresh bullish momentum in silver prices, or else we expect prices to trade between 24.50 on the higher side to 23.70 on the lower side. Meanwhile, LME base metals posted decent gains in the last week, driven by China's efforts to stabilize its local currency and reports of China planning steps to enhance funding for construction and infrastructure projects. Conversely, WTI crude oil prices traded below $80 per barrel, marking a second consecutive weekly decline. This decline was influenced by signs of easing supply tightness, improved US relations with sanctioned oil producers Iran and Venezuela, and growing demand risks in China and the US. On the technical front, a bearish engulf candlestick pattern in WTI crude oil near the multiple resistance zone is favoring the bearish sentiment. However, for this pattern to be confirmed, the price must close below $78.95 per barrel on a weekly basis. Failure to do so may lead to price consolidation within the $83 to 79 barrel per range. There is an interesting formation in natural gas as well. If you look at the MCX natural gas prices, there is a bullish a piercing line that has been formed, which is a bullish candlestick pattern. And as of now, it is trading around 2.5% higher. So a close above 222.40 on a daily closing basis would confirm the piercing line, and the prices might once again target 232.60 and higher. In that scenario, the support would be 210.60, which is the pattern low, and that would be the reversal support below which the pattern might negate. So looking ahead, volatility is expected to persist at the United States as the United States gears up for a busy week with investors closely monitoring the labor report, the PCE price index, personal income and spending data, JOLTS job openings, ISM manufacturing PMI, and the second estimate of Q2 GDP growth. Additionally, market attention will be on China's latest rollout of mortgage easing measures aimed at providing relief to the stressed residential property market and whether they meet market expectations. That's all. Remember to make smart trading decisions. It's important to stay informed about what's happening in the world of commodities. If you have questions or ideas for our podcast, feel free to reach out to us. Thanks for listening and happy trading.